The thing for, I guess, us is at the end of the day, back to being a risk management oriented organization, risk protective, that tends to actually also fit with the culture where you're saying, listen, if you have a concern, express it. This isn't about one person's brilliant insight. It's actually about saying, how can we bring all the brain power? We have an incredible team here. We are so fortunate.
Prominent CEOs, leading economists, iconic investors. Insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Welcome, everyone, to, as Susan just said, our 150th Walker Webcast. It's a real joy to have, as I get older, I'm not supposed to say an old friend, I'm supposed to say a longstanding friend, Marc Lipschultz, join me today. Before I dive into my conversation with Marc, just a couple quick things as it relates to the 150th Walker Webcast. This whole concept came out of the pandemic, where we felt we needed to talk to our clients and tell them what was going on as the world sort of shut down. And there were a couple things that were really important about what we did that has made it so that now, 3 years later, we're still at this and just doing our 150th today. The first was that Friday that the world shut down, I turned to Susan and thought, what was the time that we needed to get our act together? And we just said, let's try it next Wednesday. We picked Wednesday and we stuck with Wednesday. Many of you may recall that lots of companies put webcasts together to give information to their clients, but they moved those webcasts around. They'd say, we'll do one Friday, they'll do one Monday. I think one of the things that has made this have legs is we picked a day and we stuck to it and we stuck to a time. The second is that we were pretty straightforward that while Walker Dunlop and the people inside of Walker Dunlop have opinions and insight that is very valuable, we sort of made the decision to bring in outsiders like my friend Marc today, so that the viewers could see what's going on in the market, not from a Walker Dunlop perspective, but from an outsider's perspective. And so we have been blessed, and I personally have been blessed to have great friendships like people like Marc Lipschultz, who agree to come on here, give us an hour of their time. I'm often asked how much it costs us to get guests. We've actually never paid a guest to be on the Walker Webcast in all 150. The only person we paid was the swimmer Katie Ledecky, where the U.S. Olympic Committee pays Katie $4,800, or back then, to give speeches. And we decided to pay that honorarium to the U.S. Olympic Committee so that they wouldn't have to come out of pocket to have Katie speak at the Walker Webcast. But we haven't paid people, and it's out the goodness of their hearts. And also, quite honestly, the fact that this is watched so widely. We're now over 8 million views of the Walker Webcast. And the typical weekly views are somewhere between 70 and 100,000. My interview with Peter Linneman, not this past quarter, which just went over 100,000, but the quarter before, is getting close to 300,000 views. And at the end of the day, it's just a real joy and blessing to be able to do something like this and have people be able to look at it and get insight on the markets, and be able to listen to someone like Marc today talk about what's going on in the markets, how he and his partner have built Blue Owl, et cetera. The final thing I would say is that while this takes a tremendous amount of my time, it is a true pleasure. And from a growth and leadership standpoint, I look at people like David Rubenstein, who both Marc and I know quite well. And David talks about how much he reads. Bill Gates talks about how much he reads. And I in no way am trying to compare myself to David Rubenstein or Bill Gates as it relates to their success and what they've accomplished in life. But they are both voracious readers. And I have had to do a lot of research and read a lot of things that I typically wouldn't do in the normal course of my job if I didn't have the webcast on a weekly basis. And after having interviewed Condoleezza Rice last Tuesday, Kirill Sokolov of 13D Research on Wednesday, Evan Osnos of The New Yorker on Saturday, Ezra Klein of The New York Times on Monday, I had to jam last night to get myself ready for this talk with my old friend Marc today. And at the same time, it was a joy at 11:30 last night pulling together some of my questions for Marc. Let me do a quick intro to you, Lippy, and then we'll dive into our conversation. Marc Lipschultz is co-chief executive officer of Blue Owl Capital. Marc co-founded Blue Owl Rock Capital Partners, the predecessor firm to Blue Owl's credit platform. Prior to co-founding Owl Rock, Marc spent more than 2 decades at KKR, serving on the firm's management committee and as global head of energy and infrastructure. Prior to KKR, he was with Goldman Sachs. Marc serves on the board of the Hess Corporation, the American Enterprise Institute, the Michael J. Fox Foundation, Mount Sinai Health System, Riverdale Country School, Stanford University, and the 92nd Street Y. Marc received an MBA with distinction from Harvard Business School and is a Phi Beta Kappa graduate of Stanford University. So, Marc, first of all, welcome. It's super, super fun to have you here. Thanks for taking the time.
Thank you for having me. I'm very excited to be here. You have an incredible webcast. I have learned a lot from you already. Well, frankly, that long predates the webcast, but includes the webcast, and pleasure to be here.
Well, it's great to have you. Marc, you and your partner, Doug, both sit on the Michael J. Fox board. And as I looked at both of your bios, it's the only overlap you have. You didn't go to the same college, same business school, didn't work at the same firms. What is it about the Michael J. Fox Foundation that has both of you on it?
So I think a couple things to highlight. Look, the way Doug and I have had the good fortune of coming together to ultimately found Blue Owl and lead it today, starts, I think, really is built on 3 foundational legs. We have had a long personal friendship. We've known each other for a very long time, but not that we were dear friends, not that we were best friends prior to forming this. In fact, thankfully, we've become best friends, but not prior to forming this. So it doesn't have that origin story. You go back to my mentors, Henry Kravis, George Roberts, they're cousins. They grew up together. So there's definitely bases for partnerships that long predate ours, but we had the friendship certainly that had existed. We had worked together professionally kind of more in parallel or in our roles. Doug was the founder of GSO, and of course GSO, they sold to Blackstone, and therefore Doug was one of the people running the whole Blackstone credit business, today the largest alternative credit business probably in the world. And I had spent 21 years at KKR and had some senior roles there. And so in our respective roles, we certainly overlapped professionally, probably more in terms of things that our groups were doing together than one-on-one. But we always had a kind of dialogue, got together every 6 months and just talked. We always had a wonderful professional relationship as well. And then to your point, community service. And I don't think it's something magical, although I think the Michael J. Fox Foundation is magical. I don't think it's something magical or mystical about that particular platform, but I think reflective for both of us, of something we really believe is important, which is engagement in the community and in important causes. And that indeed was one that we both have been involved with for a long time. And we wind the clock back, and I actually try to kind of come up with what's the first thing we actually did together. I think in 2007, we, on our spouses and some others, co-chaired the Michael J. Fox Gala. So it might actually be the first tangible thing I can point to that we definitely did together.
It's kind of neat. So you mentioned, Marc, that both of you left really big jobs in really big private equity firms. And you've built a 17 billion plus market cap company. So the success you've had is phenomenal. But what was it that the two of you saw outside of KKR and Blackstone that you couldn't do inside of Blackstone or KKR that said to the two of you, let's hop out and go do something new?
So Blackstone and KKR do a lot of great things. And in fact, I'm sure there's nothing we have done or could do that they couldn't do if they wanted to. But I think we've taken a different
Except you own the majority of this one.
We've taken a different approach, which is, listen, we had the great privilege of Doug having spent a lifetime in alternatives and in credit markets, building GSO, and then at Blackstone for 8 years. I had spent my decades at KKR. Our CFO had come from TPG. Our other co-founder, Craig Packer, was running leveraged finance at Goldman Sachs. So we came together having the benefit of having worked at these incredible institutions and therefore learned from them. I made reference before to Henry Kravis and George Roberts, who are just dear friends, extraordinary people, and built an incredible institution that I was lucky enough to be a part of. In fact, lucky enough to be a part of since you and I were together at Harvard Business School. Since the day I graduated, that was my job out of business school. And so, taken all together, what we were able to do was take the privileges we had from being in those places, the lessons we learned, and bring them into a focused firm where we said, look, we see also a market opportunity. We see an evolution that, if I could maybe simplify it in the biggest sense of the word, private equity had taken a kind of multi-decade arc from this boutique kind of backwater business into an absolutely mainstream asset class by the mid 2015, when we decided we were going to do this. And we thought there was a parallel opportunity in the world of private credit, or really even more broadly, as you think about the subsequent combination with our GP stakes business and our real estate business, to be able to provide the picks and shovels to this now multi-trillion-dollar gold mining industry known as alternatives.
You have in the back of your investor deck, Mark, or actually it's at the back of your website, a slide that I thought was fantastic that basically shows investors that evolution from publicly traded companies and how that number has decreased from almost 7,000 back in 2000 to just 4,600 today. So that's down by over 2,000 companies. And that companies owned by private equity firms from 2000 to 2022 have grown from 1,800 to over almost 11,000. And so you've seen this massive shift of ownership in the public markets to the private markets. And as you just said, Blue Owl is really focused on that. Is that, as I saw that stat, and it made my jaw drop, to be perfectly honest with you, particularly because you and I both run publicly traded companies. I sort of scratch my head and say, am I the idiot going the wrong way here? But do you think that's more an impact of just really smart people saying there's more flexibility in the private markets? Do you think it is something of the mark to market? I mean, obviously, private portfolios are marked on a quarterly basis, so it's not as if you avoid that, but your stock's going to move up or down today. My stock's going to move up or down today. And there's certain pressures to that are very distinct from being in a private format. What do you think has made that big sea change from the public markets to the private markets?
So there's incredible power in the public markets. You experience it, I experience it. And we're fortunate that we have these incredibly deep public and private markets. One of the great innovations, obviously, when we think about the US, we think about tech innovation, and today AI front and center. We think about medical innovation, and look no further than the speed with which we came to a vaccine and now can produce new forms of medicines, cutting edge. But one of the greatest powers of the US system are the capital markets. And I sort of think about this as that continued innovation and evolution of creating different pools of capital to meet different needs, different forms of the way you might finance a business to be able to continue to innovate. And so it's not really that one is superior in all instances to the other. In fact, I think what's happened is we've developed a private market that is, in many cases, superior for long-term planning. There are a lot of benefits to the private market, but it's really about the facts and circumstances. So I look at it and say, what we want and are fortunate enough to have in the US today are really deep and vibrant public and private markets. So I do think people select the private markets because there's an ability to plan longer, think longer, operate over a longer horizon in terms of strategy and business, but it's not without its limits. There's wider access to capital in the public markets. There's other advantages, the currency that you can create and the durability that you can build. So I look at it as broadening the choice as opposed to only one or the other is the answer for all purposes.
And you mentioned the strength of the U.S. capital markets. While Blue Owl is global in its investor base, the majority of your investments are in the U.S. Why both you and Doug ran platforms that were global in nature? You made investments in Europe and Asia and Latin America and all over the place. Why has Blue Owl's focus been predominantly in the U.S., if you will, so far? You've got over 144 billion of AUM right now. That puts you into a lot of companies that I'm sure have global footprints themselves, but the real focus has been investing either at the GP level or in the debt level in companies in the U.S. Why the U.S. focus?
In a way, it takes us into the DNA of Blue Owl. And this, what is it that we set out to build that was, distinctive perhaps from the other offerings that were out there at the time? And the strands of that DNA, I think, are kind of the foundation to answering that question, which is, I think about the two strands of our DNA. One being, well, what's the nature of the products we create, the investments that we offer to people that entrust their capital to us as LPs, for kind of a generalized term. And for us, our DNA is about risk management. Our DNA is about reduced volatility, protection of principal, preservation of principal, and durability. And so that's kind of one thread. And with that thread, frankly, the US market is a very, very strong place to be. When, every time a crisis hits, and I'm not suggesting there aren't wonderful strengths in other countries and other markets, and over time, perhaps those will be things we'll want to capture. But think about where we stand today, and think about most prior crises. The U.S. ends up standing tall. We do have powerful, innovative markets. We have our challenges for sure, but in a world of thinking about, hey, where can I deploy capital where I feel as if I'm going to have well-protected investor rights, I'm going to have a predictable framework, I'm going to have a resilient economy, I'm going to have an innovative economy, that often brings us back to the U.S. So, I often will say this about many things, whether it was by, good design or good fortune. Indeed, our investments are heavily centered in the U.S. That looks pretty good sitting here today.
So your direct lending business, which is just over 70 billion of your 144, essentially working with private equity firms that have invested in companies and putting debt on them. The vast majority of that is floating rate debt. We've got Jerome Powell in a couple hours probably saying to the world that we're going to raise by 25 basis points. One of the strengths of the Blue Owl portfolio is that most of the debt you have outstanding is floating rate debt. So it has moved as interest rates have moved, which has been very beneficial to you all and to your investors. As you can imagine, Mark, in our business, floating rate debt is a great thing until all of a sudden your debt service coverage ratio gets to a point where you're getting choked by that move in rates, and credit becomes a very significant issue. When does credit become an issue from the Blue Owl standpoint, given the companies you invested in? Typically senior secured investments, but also floating rate where, 2 years ago, those borrowers from you all were paying coupon rates in the 1-2%, and today they're paying in the 6 to 8%.
So absolutely, we provide senior secured floating rate debt in our credit business. And this, therefore, has been candidly a good environment for our business. It's sort of what we're built for. There's sort of a time and a place for everything, so to speak. And this idea of a maybe economic uncertainty, rate uncertainty, but rising directionally in terms of where we've been the last 18 months is really what we're purpose-built, the moment we're purpose-built to meet, because it is about being senior, protected in the capital structure, and getting paid so in as close to inflation protected as one could come, because as inflation is being fought, rates rise, we directly flow that through to the borrowers and therefore to our investors. So it's a quote beneficial environment for what we do. But Willy, to your point, like anything, too much of a good thing, so to speak, at some point, any company, any economy, this is the balance the Fed has been so far walking with kind of extraordinary aplomb. I mean, sitting here today, to be extremely self-aware, a year ago, I would not have forecasted that we'd be sitting where we are today, which is this idea that somewhere up here was this hyperinflationary environment, somewhere over here was this recessionary environment. Those are kind of big blocks. Somewhere in between, there was this spot we want to porpoise our way into. Sitting here right now, the porpoise our way in case looks more, most probable of the existing cases. And so with that said, to come to your exact question, right now, I think we're landing, certainly from the Blue Owl point of view, and I'll try to, as best I can, to extrapolate it more broadly, because we do have several hundred companies that we lend to across all industries. So I think it's not a bad sampling of what's happening, and again, particularly the U.S. economy or U.S.-based businesses. They're often global, as you point out. And what we're seeing is it's working. Companies are still growing. Revenue and EBITDA is still growing on average. Coverages are still perfectly healthy. Our companies, it's of course, they aren't the coverages they were before, and it has to be a mathematical certainty that someone who could perfectly comfortably cover their interest when LIBOR SOFR now was 0 has a greater challenge covering it when it's 5. But the durability is strong. I sit here today, and our portfolio, we have not seen any material changes in the credit posture of our profile of our portfolio over the last year.
It's really, to your point, Mark, the threading of the needle has been, I mean, you look at the Dow over 35,000, and there are those people who would say it's heavily concentrated in the 7 big tech companies. And that's a fair criticism. But at the same time, to hear someone like you who has hundreds of portfolio companies that you all are obviously monitoring on a day-to-day basis, it says that the health of the economy stays quite good. And the fact that the Fed funds rate has moved by this afternoon, probably 525 basis points in the last 16, 17 months. But, the 10-year has only, and by the way, look, our borrowers are feeling it on the 10-year, but the 10-year has only moved about 100 basis points over the last year. And so while you've had this huge move in short-term rates, at least in the commercial real estate space, most people are sitting there off of the long end of the curve. And while 100 basis points can make a big difference, I'm not trying to diminish that, it isn't quite the shock to the system that I think many people, if we were having this discussion a year ago today, would have projected for the economy.
Yeah, but that's, I think, well said, and that's the experience we're having. And I'll just amplify, which is not to be repetitive, but our lens. Look, we lend to the very largest private companies, backed by the very largest sponsors, but those companies are very small compared to the mega caps. Of course, you're talking about, they're driving the Dow, so it is a distinctive lens that I think many people listening to this, I suspect, would more characterize as the kind of upper middle market of the world, as opposed to anything like those mega cap companies, even though our language in our own little world might be different. And so it is a pretty broad sample. And my statements are intended to be pretty broad, which is to say that across industries, not without flaw, not without individual companies, there's always going to be peculiar challenges, different enterprises, peculiar wins they have. But across industries, we are seeing that it looks like we're still in a solid economy with businesses that are generally able to absorb what you could either characterize as a shock or change in the short-term costs, with, as you say, looking forward, and not such a shock or change in their long-term profile.
A bunch of your direct lending business, Mark, is to technology companies. And I had a kind of mind-bending discussion with Ezra Klein of the New York Times on Monday at the Sun Valley Writers Conference. And prior to sitting down with Ezra, as you can imagine, I had to do a lot of homework on AI. And I asked Ezra, are you in the camp that AI is going to kill us all in a very short period of time, or whether AI is going to actually transform the world in a very beneficial way? And we talked a bunch about DeepMind and the work that DeepMind did with AlphaGo, which was just to win a video game, and then to AlphaZero, which was to win a video game, but with no real parameters behind it. And then to AlphaFold, which has done incredible work on protein discovery, if you will, and the folding of proteins. And previously, prior to Google and DeepMind focusing on this, there were only 150,000 completely sequenced proteins. And by using artificial intelligence, they've now successfully sequenced 200 million proteins. And that treasure trove of data is going to allow for medical research and drug development at a rate that I think is unprecedented. Which, as you look at technology companies, I think I have 2 questions for you. One, how much is AI sort of changing the focus of the companies that you've invested in? Because you obviously have, business plans with private equity firms that you invested in certain technology companies that all of a sudden right now might be saying, whoa, we need to shift. There's a real change in the market, change the strategy. How prevalent is that? And then the second, just on a personal basis, are you in this stuff's going to kill us? Or are you in this is going to be really cool and change the world for positive purposes?
Well, maybe I'll start with the second.
Yeah, that's probably the easier one.
Yeah, it might be the easier one. So look, I view, and I don't want to pretend to have a depth of understanding. We're all learning about this. And frankly, AI is evolving so rapidly, I think it'd be dangerous to sort of state much with great conviction about the exact path it takes. I did just finish reading The Age of AI, which is Eric Schmidt and Henry Kissinger's book on this topic, which is more into the kind of policy implications, global relations implications, but obviously probes what does AI look like and mean. And I think it actually reflects something closer to at least the way I understand the world and think about it. This is another incredible productivity tool that, like every productivity tool, comes with dangers and it comes with disruptions, and I don't minimize any of that. So I'm not a Pollyanna about it. I'm not, and it's, hey, no problem. I think like most innovations, and even whether they're giant in scale like this or smaller, they tend to be able to be used for better or worse. And maybe it comes at a time right now, and I'm privileged to see an Oppenheimer yet, but think about nuclear power and nuclear weapons. They can the discovery and our understanding of the nuclear level, of the atomic level of the universe, has been one of the most important things we've discovered. It also created weapons that can be used to destroy the world. So it's hard not to picture AI as being able to be used in different ways by different people. But overall, it's a tool of incredible power to bring knowledge and observe patterns that we can't see and inform our decisions. Hopefully, and that's the part that I can only say hopefully, we're going to develop the right kind of frameworks for how we use AI and common understandings of how we use AI and don't, so that we, it doesn't sort of get ahead of us. My kids always say I'm too much on the side of the robots, which is sort of interesting because they live in a tech-enabled world. So I read a book like The Age of AI, and I feel pretty good that there's odds are we can land. I also saw the new Mission Impossible, and that's a much scarier case. My kids said they told me so. So we're in a vast evolving world. I'm on the more bullish side.
Just one quick one, and then I do want to ask you about the specific portfolio companies and sort of a change of strategy or not. When I was interviewing Evan Osnos of the New Yorker on Saturday at the Sun Valley Writers Conference, as we were talking about AI, he made the point that he just interviewed Sam Altman, the founder of ChatGPT, at the Allen & Company conference. And Sam Altman and Oppenheimer share the same birthday. And it was just one of these kind of like really eerie kind of things. Is that just coincidence? Is there something about that? But when he said that, everyone in the room sort of had this big kind of gulp of sort of like, oh, that's really wild. But anyway, for whatever that's worth. But talk about, Marc, there's XYZ portfolio company, the private equity firm invested in 2020, and the strategy was X on social media, on ticket processing, whatever the case might be. How much has AI come in to sort of say, whoa, this business is changing dramatically because of AI? And to some degree, there's a job for Blue Owl to do to sort of re-underwrite the loan.
So let me sort of set the stage. Indeed, we do a tremendous amount of lending to the software sector. Now, it's tech, but if we boil down to what we really do at Blue Owl, it's software lending. And we are, I think, quite clearly the market leader. I think we probably have close to $20 billion in loans and investments with software tech companies. And we have a team of probably 30 people dedicated to this topic alone. So I say that just to inform kind of where my comments are going to come from. So AI for us, has two dimensions to it. One is, what does it mean for our business? And we formed an AI task force, and we're lucky because we do have an extremely deep technology bench, and we do have a very wide portfolio. So I think we're in a very distinctive position, even relative to our peers, to be able to develop a more informed view to be able to act on around AI, both for ourselves, what does it mean for Blue Owl, and therefore our LPs, and how we help them benefit from our application of our adoption of AI. And then to take it to your point, our portfolio companies, and what are the implications for our portfolio companies? Now, obviously, both of those are still, of course, works in progress. But with regard to the portfolio companies, the reason that we have been positive and remain very positive on lending to software enterprises relates to the fact that they have these embedded customer solutions, right? Automated, that is to say, tech-enabled solutions for what used to be more manual processes or less efficient processes. And those companies are frankly in the best spot to adopt the beneficial aspects of AI and deliver it to that customer base. The power of software is that you have the customer relationship, the embedded connectivity, and AI in most applications. It's not as if you're just going to ditch everything you have. It's going to change the way you do what you do. And so far, again, back to this friend or foe AI writ large, I think friend or foe AI for most SaaS software businesses, again, that's what we do, I think is actually decidedly more friend, because they're going to be the ones that are going to adopt the tool and figure out how to purpose it into the specific application. Medical records, who's better informed to do it than the tech company that already handles electronic medical records for hospitals? Who's in a better position to handle EHS compliance, electronic certifications and management and integration with delivery to governments and other stakeholders than the person who already manages that customer relationship and is a tech-enabled company? These aren't lumbering old businesses. These are very front-footed businesses. So I don't dismiss by any effect or any element the potential disruptive effects around, so to speak, that the edges. Someone might be the victim of the change as opposed to the beneficiary. But so far, it looks like it's something that will be an adopted tool and be helpful to these software businesses over time.
As I hear you talk about that and these types of sort of innovative companies that you're underwriting from a debt standpoint on your direct lending business, just kind of maybe an odd question. Maybe it's never happened. Maybe it happens all the time. But you also have a GP Solutions group that has over almost $50 billion of capital outstanding. Do you ever go to underwrite an opportunity that's on a software business, for instance, and they've come to you for a debt solution and you say, well, this is so exciting, we want to be on the GP side? I mean, do you ever change the conversation? Or if whichever XYZ private equity firm comes to you and says, look, we're looking for debt for this investment, your underwriting is debt and you stay in that lane? Or has your team turned around and said, whoa, and hold on, we want to jump across and be on the GP side?
Okay, so it's an outstanding question. And it actually gets to the second thread of the DNA metaphor I used before, which maybe was appropriate in the context of AlphaFold and others as biologics. But I was talking before about the one thread being low volatility, low risk, delivering durable alternative solutions to investors, to LPs. The other thread, the users of our capital, the commonality that ties them together is they are indeed alternative investment firms, often private equity firms, to your point, in many cases, saying, hey, I need a capital solution. And in fact, the design of Blue Owl is all about the one-stop shop you're describing. It's not so much about, whoa, hey, we'd rather go do this, as much as it's saying, listen, bring us your opportunities, your challenges that require capital solutions. And most things require capital. And we will help you find solutions. And then you can decide which solution suits you best. Our job is to work for our LPs. Our job, our fiduciary duty is to deliver to our LPs, great risk return. For us, the more opportunities we can get in the system, the more times a partner, a company, or a PE firm says, I want to work with Blue Owl. Yeah, I understand with the price that may entail. I want them as my partner. That's a benefit for our LPs. So the way I would take what you described is not so much, hey, I love this portfolio company, but I'd rather do this. It's more, I love this portfolio company. Isn't that interesting? This GP is doing some really fascinating things. We should make an introduction over to our GP stakes team to see how they're thinking about their GP and whether there's also an opportunity for us to support them there. And that's really how we've built this ecosystem. And you happen to use a word I use a lot, this kind of, hey, stay in your lane. And you asked me before about kind of how we are, what other firms could do or not do. Blue Owl, when I take that DNA and focus it together, and now I'll switch metaphors quite intentionally, there are strategies out there that are, look, all things to all people, right? There are firms that it's about delivering all solutions of all types to all people in all parts of the world. That's not what we are. The single lane answers too. That's not what we are either. We have a compass direction. Our compass direction is north. And what defines our compass direction is those DNA strands I described. It's sort of the kind of products we deliver for investors on the one hand, and who uses our capital on the other. That's the power of, that's the highway we occupy. And we have certain lanes we occupy well today with market leading positions in providing capital to GPs, in being a direct lender to the biggest companies, to the best sponsors, in doing triple net lease solutions for the biggest corporations. That is where we live today. There's other lanes in there, some of which we will occupy over time, but we're on a highway going in a particular direction. So that's really the way almost to picture why does Blue Owl even exist? Why are we prospering? Is because we have a defined path, but it's not as narrow as a lane, but it's not as broad as all directions on the compass.
So on your GP Solutions business, Mark, it was funny as you individually are a member of the Washington Commanders. And by the way, I hope you take it back to the Washington football team, just as an aside. That's my plug. And I'd also love to see you have my friend Taylor Heineke come back to the Commanders. But that's just a personal plug on the webcast for two things as an owner of the Commanders, my team from DC. But as I was sitting there, one of the questions I was going to ask you was, had you, an individual, looked at other types of sports? And then all of a sudden, as I was doing research, I saw that Blue Owl has worked as a GP to buy GP interests in other professional sports teams, such as the NBA, where Blue Owl invested as an investor in the Phoenix Suns, as well as the Sacramento Kings. Talk for a moment about sports and GP interest, because I guess the premise here is this: there are only so many billionaires who can stroke multi-billion dollar checks to buy these franchises. These franchise costs are going up and up and up. And so by being able to play on the GP side, you're providing liquidity to owners and then also providing an investment opportunity that your investors wouldn't be able to find on an individual basis. Am I right in sort of the way you all came to this?
So look, I'm lucky enough to be a part of the investor group, the ownership group for Commanders. But listen, this is Josh Harris's team. I'll pass on your
please do. I have to say though, Mark, just by the way, when I talked to Condi Rice last week about being a part owner of the Denver Broncos, first thing she said was, I own about 4 helmets, which was great and self-deprecating. And at the same time, there is a reason that Condoleezza Rice is an owner of the Broncos, and there's a reason you're an owner of the Commanders. So let's just leave it at that.
Yeah, okay. Well, we'll all work to discover what that reason might be for me. I'm quite sure they benefit from her. But in any case, we, Josh and Magic Johnson and Mitch Rales, are doing an incredible job with that team. I'm very excited to be a very modest part of it, and look forward to, as they've said, seeing the team return to its extraordinary strength. And it is fans like you that are going to make the difference. And you heard Josh say this, changing the fan experience is top priority. So
I have to just one final thing is that I have to put in here. The Commanders for years have tried to get, because Walker Dunlop's based in DC, they have tried for years and years to get me to get a suite. And I've said to them time and time again, look, I love the team. I love football, but as long as they're owned by X person, I will never consider it. So as you can imagine, their first phone call on the day that the team was sold was to me saying, all right, that was your one condition, that you wouldn't buy a suite. So we may have another conversation after this on it.
Well, wait, it's being recorded. So wait, can I get your commitment for a suite right now?
All right, exactly.
Right here. Value for the team.
You got it. But anyway, but on the NBA side and on buying GP interests and other outside of your personal investments, what you've used the GP fund to do in sports, because sports clearly, not only does it have a lot of attention right now. I had Greg Maffei of Liberty Media on the webcast a couple of weeks ago. Greg obviously owns Formula One. They've looked at all sorts, but right after Maffei was on, you had Bob Iger, CEO of Disney, talk about basically potentially spinning off all of their cable channels other than ESPN. And you sit there and you go, what's different about ESPN than all their other program television? Live sports. And so, there's so much interest in the value of these franchises gone up so much that Blue Owl's product offering to be able to go and invest in GP interests on professional sports teams is a really interesting angle.
Yeah, and you're hitting on all the forces that inform the development of that strategy. There's a clear analog, and a strong and good one, between being part of a sports ownership group, a minority owner in a sports ownership group, and being a minority owner in one of these alternative asset managers, being a minority owner in one of the GPs that we fund today. And that analog is what brought our GP stakes and solutions team to the topic of sports, and continues to give us, I think, some real work ahead and opportunity ahead in sports. So what does that mean? It means you have to be able to know how to identify the accretive opportunities, like who's really built to win economically as an alternative firm or as a sports team. You need to have patient long-term capital, because these are not assets that are being bought and sold with any frequency. And that's the case with GPs and with sports teams. But they're also extraordinary franchises, right? You think about the Silver Lakes and the HIGs and the CVCs and the Veritas, the firms we're lucky enough to be owners of on the GP stake side. They are incredible and enduring franchises. analogous to the sports point. So everything you're suggesting is exactly what brought our team there, which was, look, there's a huge marketplace evolving with capital needs, to your very point, that are rapidly exceeding what is available in the individual investor marketplace. And so we've already been doing this in basketball. We are the approved partner of the NBA for these minority stakes. It's a strong place to be. It's a great opportunity. And building off of that, we're now looking at, well, what can we do more broadly as institutional capital becomes maybe not just welcome, but necessary in most sporting arenas. Frankly, the only place where institutional capital, as you know, today isn't permitted is the NFL, and we'll see what they decide over time.
Yeah. They might have to, if the value of these franchises keeps going up much more, they may have to change some of those capital rules that they have on the NFL side. And a shout out to the Denver Nuggets for winning the NBA title this year. I was there the night that they won it, and it was a really exciting thing. So let's switch to real estate for a moment, Mark. So your Blue Owl's real estate platform was just named a top performing real estate core and core plus fund manager by Preqin, and Mark Czar and his team, hats off to him for having built that platform. There's a lot of concern about commercial real estate today. You're talking to somebody who gets questions on it every single day. What's Blue Owl's outlook? And I know your investment strategy on triple net properties and big corporate users is somewhat distinct from other strategies like, I'll pick at Blackstone for a moment, that basically has their hand in every single type of asset class globally: office, retail, hospitality, multi-industrial, although to the B-REIT's great credit, they really did in the B-REIT just focus on multi and industrial, and it's held up quite well after kind of the run on the bank that they had in Q4 of 2022. But talk for a moment about Blue Owl's 20 billion plus in real estate and why it's distinct.
So I'm going to have to be very cautious in talking about real estate with a world-leading expert in real estate. So I'm going to tread carefully. So I'll try to stay close to my knitting, which is knowing what we do here. And, all this hopefully will integrate in people's minds when I talk about what we do and how we define our highway. And I talked about that lower risk, lower volatility, principal protected investment strategies. That's what we do. Well, that's what we do in real estate. So in real estate, by measure of the breadth of the real estate industry, we're very small. By measure of the particular niche that Marc Czar so cleverly identified well over a decade ago and has architected this leading position for, we do triple net lease, generally 15, 20-year leases with investment grade or strong credit counterparties. So the expenses, of course, in a triple net lease solution are not so in an inflationary environment. That's not a risk for us and our investors. That's something that the tenant manages. And it's all about durability and predictability of those income streams, which during a bull market, people are fine to have. But in a risk on market, it's sort of like, well, that's nice. In a risk aware market like we're in today, you get a lot of recognition, and we do deeply appreciate the recognition from Preqin, kind of exactly the point. Hey, you know what? It turns out there's a lot of different flavors inside these big words called real estate, inside a big word like credit, inside a big word like equity. Our flavor is, again, sort of this is its moment to shine, because what we're providing people is that predictability and certainty anchored by an attachment to a great tenant and a critical asset. So from where I sit, I think it's a spectacular strategy that I didn't create it, that Marc created to provide visibility and durability and a way to participate in real estate through this kind of disruptive time and have it, in fact, not be a drag. It's actually a loft for our strategy, because cap rates in general are rising because of the malaise around the sector. And yet within our particular niche, it's not as if the risks of doing an Amazon warehouse have gone up. So we're generally pleased with the environment that we face off against.
I love that term, risk aware. It's like, first of all, backing up to what we talked about previously about where we are versus a year ago. A year ago was clearly risk off. Across and a lot of commercial real estate, as you know right now, Mark, is still in a risk off mode, but it is moving quickly, I think, to risk aware. And that's going to create more opportunities and capital flows coming back to commercial real estate. And I think it's credit to Marc and his team that on the Blue Owl platform, given the investment strategy, that you're able to be risk aware right now and not risk off like many, many other providers of either equity or debt capital, the commercial real estate space.
Yeah, and I'm glad that term resonates, because I think it, in a way, captures exactly what we've been talking about around Blue Owl. Like, risk matters, and how you manage risk matters. It matters in good and bad times. It's just not visible during good times, right? It's more visible during more challenging times. And that's where we really have our kind of bread and butter, is building products that are built in a very risk-aware fashion. And so we these uncertain times, I think that's why, again, we're taking it up a notch. It's kind of why it's, generally speaking, favorable for what we do. I'm not trying to be a Pollyanna. Uncertainty is an enemy of capital formation. I don't know the future, I for sure, and who knows where we'll land. But I being in a business where you're very tuned into risk, this is the environment where that tends to shine.
You talk about risk management, Marc, and let's talk for a moment more broadly about the management of Blue Owl. Only in that you have co-CEOs in you and Doug, and you actually have 3 co-presidents. And as the old adage goes, if someone doesn't own it, nobody owns it, has been a sort of a management philosophy that at least Howard Smith, who's our president, Walker Dunlop, and I have pretty consistently tried to put into place. That these divisions or businesses need to be owned by somebody, and if it's by a group, you're never going to get to the right solution or the right ownership of it. You all have clearly been extremely successful being in sort of this partnership senior management structure. What's either unique about Blue Owl or just the relationships that you all have with one another that's made a co-CEO and 3 co-president structure work?
So, fully acknowledging that it's an atypical structure, certainly less common than not. And in many cases, I don't think there is, back to this account, there's not a one size fits all. It depends on the nature of the business and the nature of the people and what the risks in the business are. But I would actually say it's pretty consistent with actually our view of risk management, which is we're trying to build an institution, and I think successfully build an institution that is way bigger than any individual. So I suppose the corollary argument would be if no one's in charge, if not one person's in charge, then no one's in charge, the alternative would be, well, okay, but then if something happens to that person, then what happens? So I think our idea actually probably is wired to our personalities and style and culture, which is we don't want failure points. We don't want anyone. And by the way, no one of us matters. And that applies across the board. We're trying to build an institution that always has a redundancy. And I give Doug the credit for this. Doug was CEO, said, hey, listen, you should join me as co-CEO. People don't do that. And he does it because he's saying, I know what's best for Blue Owl. Our co-presidents are incredible leaders for this business. But it's very clear where different bucks stop, and yet we can kind of get the best of all our minds on a topic too. So Marc Zahr is co-president and runs the real estate business extraordinarily well. And Craig Packer is the co-president who runs our credit business extremely well. And Michael Reese is the co-president who runs the GP stakes business and was the founder of that business extremely well. So we have very clear kind of places where we wake up and focus each day. But that also gives us, the ability to share knowledge, share information, share origination ideas, take those ideas and cross them over to the benefit of our LPs. But it also gives us that backup. It builds the depth we need so people can know that it's not just Blue Owl, and frankly, in alternatives, this has been a big issue. Is it a cult of personality? Is it about any one person or two? It's not. In our world, it's about the Blue Owl platform. We're thrilled to be a part of it. We think we add value in our roles, but if any one of us got hit by a bus, Blue Owl carries on.
Marc, one of the 4 ethos of Blue Owl is constructive dialogue. And when I read that, I thought about Ray Dalio. And I thought about the quote unquote constructive dialogue that Ray tries to put into his firm. And I'm just curious, given having a leadership team that is so wildly talented as you have at Blue Owl, there would be an assumption from an outsider that there are these super successful, super talented senior management team that sort of says, we're going there and let's go do it. And so having constructive dialogue as part of one of your ethos is, I thought, very interesting and important to understand. How do you, at a firm that is run by people who are wildly successful and have very strong opinions on things, make sure that that constructive dialogue happens on a day-to-day basis?
So like anything in culture, it is about reinforcement and sort of walking the walk. And again, like everything we do, I'm far from asserting we've got this sorted or perfected. And that would be my answer on any subject. Sort of everything's a work in progress. But the thing for, I guess, us is, at the end of the day, back to being a risk management oriented organization, risk protective, that tends to actually also fit with the culture where you're saying, listen, if you have a concern, express it, right? This isn't about one person's brilliant insight. It's actually about saying, how can we bring all the brain power? We have an incredible team here. We are so fortunate. Since inception, I'm sure there's an exception to every rule. I can't think of anyone that we have lost that went to a competitor. And I think that speaks to kind of cultural and kind of I think it's a good place to work, but I think it speaks to this culture of inclusion and dialogue and really valuing individuals' opinions. So listen, never will be anything like as successful or insightful as Ray Dalio. And you made reference to other incredible business leaders, many of whom you've interviewed, and I'm none of those things. But what I guess I'd say anchors us is having been in alternatives since 1995, long before it was called alternatives. Having been in private equity before it was called private equity, it was LBOs back then. When I started, there were two large LBO firms in the world. Two. There was KKR and Forsman Little. TPG was a startup, right? Blackstone.
Carlyle was a postage stamp back then.
So it's just an incredible evolution in these markets. And you know what probably my most significant takeaway would be is that will give you a lot of humility, and that will give you a lot of sense of, right place, right time counts for a lot too. And I'm not taking away anything from the skills that people who crafted these enterprises have. Within my world. And I think we've had some good ideas, but time and place counts. And, the kind of macro, the tailwinds, the ecosystem you operate in counts. And I think that humility of recognizing that a lot of our success comes from things that are outside our control, and so do some of our failures, I think helps us also then build a culture where we say, so none of us have all the answers. We just don't. So the more we can encourage people to say, I don't see it that way. We may not reach the conclusion they're advocating, but boy, we should hear it. As soon as you get in that echo chamber where you're not hearing from people anymore, and this again, lessons I've learned over time, it's very easy to get into a culture where it's easier just to sort of say yes, get along, you have a different view. But the most toxic thing, I think, in any culture, again, recognizing the limits of my knowledge, is we finish a meeting and everyone nods their head, and then they go off to get a coffee, and they're like, oh, it's that dumb idea. Yeah. That's just the worst possible thing you can have, I think, in a culture. So we're trying hard to fight what happens as organizations grow, to say everybody's opinion matters, and you may or may not believe it, but we want to hear it. And we love when you disagree with us if you have a good reason to. We're not saying let's disagree.
Yeah. No. I got it. I know clearly your focus right now, being co-CEO of Blue Owl, focuses on all industries, the various products that you all are putting out, et cetera, et cetera. But I can't let you go without talking about energy for a moment, because you truly are an expert on energy. You ran the energy practice at KKR and infrastructure. Two quick questions for you on that, Marc. First, I watched a number of your videos on alternatives, on wind and solar and things of that nature from a decade ago, speaking out at Stanford University. What surprised you the most over the last decade as it relates to alternatives? Either they've exceeded expectation, they've undercut expectations. One of them has grown much faster than you had expected. What's been the biggest surprise in the alternative fuel energy space from your standpoint of where we were back in 2013?
So I think there's good and bad news. The good news is it's been working. That is to say that renewables as a part of the energy complex have decidedly been growing. In some cases, again, depending by region, and as you know, electricity is a complicated animal. In some cases, much more than people would have expected. Wind in West Texas, has grown more than people would have expected. Some of the applications of residential solar. Now, a lot of these things are driven by incentives that have been created to lead to these results. So I don't want to suggest they're just things that happened in the sort of open field of market play. But nonetheless, you'd arguably have seen a great success in the implementation of renewables in many parts of the US and around the world. At the same time, the bad news, but I think the recognition we have to get from here through a practical energy transition over the long term is the recognition that we have a very long ways to go. And we don't today have the technology, the capability to move as rapidly as perhaps people would like, perhaps people want. There'd be a wide range of views on this, but in energy transition, we're going to be with carbon fuels for a very long time. And so the key here is going to be, how do we get from today's world to that low carbon future, and do that in a way that is healthy for the environment, but also allows for economic vitality. And so I think the good news is it's working. I think the bad news is there's a bit of impatience, and this is going to be a long process. And I think we're going to need to sort of take all of the above strategy to get from here to there, realistically.
And on oil, if we've got carbon fuels around for a longer time frame than many would potentially like, a year ago right now, oil was at 110 a barrel. There were a lot of, I actually was looking back and I'd read an analyst report by a Truist analyst a year ago that was saying that oil was going to go to $160 a barrel. Good thing I didn't read that report and go long oil. And, it got down to $75 a barrel last week. It's back up close to 80 today, 79. Just generally speaking, Mark, what's your sense as it relates to oil going forward? Are we looking at that it's kind of in this band because of supply and demand characteristics of where the market is? Or is there something, given your deep expertise in this space, that would say to you, it's probably goes down from here, it probably goes up?
So a couple of thoughts, again, recognizing with
I got all the caveats you're going to say here.
Okay,
I want to sense of, know much more about this than I do. Should we think that oil is going to be $100 a barrel? Should we think that oil is going to be $50 a barrel?
I think you need oil prices that are closer to where we are now to rebuild the pipeline, pun partly intended, of energy that we need. Remember, we went through a period of time over the last several years where there was dramatic underinvestment in production, and it does deplete. Again, some people will view that as good news that it depletes, but the fact is, when you still need it, that's not good news because you have to replace it, and it's very expensive. And so without being able to know, I would say you need prices that are closer to today's to make a return on capital work in the energy complex. And that's just a reality. I'm thankful that, it's funny you said that about forecasts. I remember the last energy super cycle in 06, 07, and people were talking about $200 a barrel. And I've always marveled at the fact that you can be an energy price forecaster and be off by, not only orders of magnitude direction, and you're still a forecaster. It's actually quite a job. But that said, I just do it from the bottoms up, which kind of is the way I tend to work and think. And if you just look at what you need to get to make a return on the capital it takes to just stay even on oil production, let alone, grow with economies around the world, you probably need prices closer to what we have now. But we're certainly not meaningfully lower. I mean, you can debate whether they're higher or lower. That's the whim of the market, or maybe on OPEC a given day.
And last tough question for you. We're probably going to have a 5.25 Fed funds rate by the end of the day today. When would you project? I mean, the forward curve has been wrong ever since we got into this tightening cycle. And the forward curve set a 4.13 Fed funds rate by the end of the year back in May, and then it went up to a 5.25, and now it's rallied back down into sort of the high fours. Just from a rate standpoint, Mark, you think that we hang in this higher for longer range, or do you think that the economy steps backwards and we've got a cut coming up in the next 6 to 12 months?
So most importantly, I'm thankful to be in the floating rate business, so I don't have to know the answer to that. And I say that only half facetiously. That kind of is the point of our strategies. So I'm fortunate that I don't have to depend on that answer one way or the other, because that's exactly what we adjust for. With that said, I would make this observation. I don't know where rates are going. I have no greater insights on that, and lesser than you and many others. However, on inflation and knowing how that looks through the lens of companies and with some meaningful reflection on this question, inflation is a tough animal to tame. And so I think if I could come out this door, inflation does not go away easily. And full credit to the Fed, we seem to be making progress, but that would lead me toward it's not so easy to take your foot off that brake, because we're still in a place with very tight labor markets. Good. Lots of people have jobs. Costs are still very high, right? That's a lot of pressure, though, on people's pocketbooks. But inflation has not gone away. It has abated from its peak. So I would be in the inflation remains a risk category, more so than, again, sitting here today at the company level. The recession doesn't look imminent. Doesn't mean we're not technically going to be in one. I don't know. But that doesn't look imminent. Inflation is still a beast to finish being tamed.
Marc Lipschultz, it's a true pleasure to have I should say, again, I'll go back to it, not an old friend, but a long-standing friend such as you on the 150th Walker Webcast. Thanks, Lippy, very much for spending the time with me today. It's a real pleasure, and congrats to all that you and Doug and all of your colleagues have done at Blue Owl. It's really fun to watch.
Thanks, Willy. And thanks so much for having me. It really is a true privilege. And our longtime friendship is very high on that list of real privileges. So thank you.
It's great. Have a great day. Thanks, everyone, for joining us.
Go Commanders.
Yeah, exactly.